All right, welcome everybody. We are live. We made it. I know it's been a few weeks. I apologize for that. Technical difficulties, all kinds of stuff have prevented it. Some market moves, all kinds of things. But here we are. I'm here to help however I can. Let's hop in. Let's get into some questions, and let's talk markets. I haven't done a whole lot today. Really haven't done anything since the sell-off. I was positioned long, as I shared on Twitter. I thought it was in Nasdaq. That is, I thought it was a pretty good opportunity to hold some. There was certainly some potential the way we had put in lows throughout mid-November. Certainly some potential for a stop run through that, and that's certainly what we've gotten here. Beyond that, do I see any real favorable downside, or am I looking to take advantage of the downside? I'm really not. Might be a trade for you, and if so, that's great. Hey, what's up, Christopher? What's up, Raphael? Christopher says, do you consider an evolving R while in a trade? If so, do you have rules or framework to incorporate it? So let's explain this to everyone real quick. What do we mean here? So let's say that we have two key levels we're looking at. And, the market breaks through and we end up getting long here. And we have a stop, let's say, here. Okay. And obviously this next area here will be our target. So if we entered here, we have 1 unit of risk, right? And I'm just going to ballpark this. Let's just say that it's 1, 2. Let's just say that it's 3. Okay, I know it's a little bit less. Plus 3R of reward, right? The way a lot of people think about and question and talk about trading is that once this trade starts to go in your favor, right? Let's say it goes to here. Well, at this point in time, what's the risk reward? And it's logical. It makes all the sense in the world that we would say, well, my stop is still here, so I'm essentially risking, let's say, 2R to make 2R, right? 1, 2, or 1, 2. So at this point in time, and anywhere just 1 tick, 2 ticks, 3 ticks above this area, people start to say that risk reward is actually no longer in your favor to be in that trade. And they come up with all these reasons as to why you should exit the trade or do all kinds of things. To give you an answer to your question, I forget who asked it. I think it was Christopher. Yeah. No, I don't believe in this. I think that if we get really close to the target, I mean really close, given the current volatility, right? You have to understand, like for a Nadro trader, rhythm and how much movement there is. And when we just say close to the target, that can mean different things to different people. And so for us, it means some specific things. When we're close to the target, whatever that means for you, now's the time not to be a D for a T, as we say. Now's the time when there's a tremendous amount of diminishing returns. Tremendous amount. But I don't believe in monitoring that along the way. I'll tell you what I do believe in, and what I think people miss the boat on when they get a little what I would call one-dimensional with this type of evolving risk-reward thinking. They forget the other side of the math. They forget the other side of expectancy and edge. What other thing do we need to consider here, guys? Let me know in the chat. What do we need to consider if we're going to have this conversation around evolving R? What else do we need to consider? Ding, ding, ding. Win percent. Where's win percent in this conversation? And what are the implications of win percent as this trade evolves in our favor? That's a big deal. Because logically, as a trade gets closer and closer to, let's say, actualization of profit by hitting a target or whatever it is, the percent chance of that happening gets higher and higher and higher and higher. So rather than just simply focusing on one dimension, my favorite dimension of a trade, risk reward, be a little more holistic. Open your mind up to the fact that we're talking about our job here. We're talking about expectancy. We're talking about percent chance of being successful coupled with risk reward when we're right and when we're wrong. And so I would argue that the edge doesn't change. As risk reward is reduced, win percent is increased, and it's actually unchanged edge overall in the trade. I'm the only person I know that talks about it that way. I'm sure there's a lot more people out there, and I know there's a lot more people out there way smarter than me who've thought through a lot of these things, especially like some quantitative folks. But people tend to forget about that aspect of the equation. All right, a lot of questions to get through here. What's up, Trader77? Maverick Mitch, hey Merritt, when it comes to building strategies, how do you incorporate MTF? I don't know what that is. I guess multiple time frames of the same ticker and or incorporate market internals. So let me know in the chat if MTF is not multiple time frames for your question. I'll try to keep up with it. How do I incorporate them? I mean, multiple time frames are everything, guys. I mean, multiple time frames is a three-dimensional view into markets. If you're not doing that, you're showing up to a gunfight with a pocket knife. You know what I mean? I mean, it's huge. You have to be able to frame context, and then further enhancing, I think you look underneath, let's say, a middle time frame. You have context, you have a middle time frame where you're making most of your decisions, and then I think even a lower time frame can be absolutely huge, and that's kind of what I call kind of a three-dimensional view of a market versus a singular type of the view. So I mean, how do you incorporate it? You use them. I don't know. It's important to pick time frames that will work together. So for example, if you're trading on a 1-minute chart, don't make your higher time frame. I see a lot of stock traders do this just because everybody thinks they should look at the daily chart. They trade on a 1-minute chart and they look at the daily chart for their levels. Those are too far apart. There's a concept around rhythm and acceptance and things that are Nadro trader driven things. And if you get one tick above or below a level, let's say on a daily chart, it doesn't mean anything. Depends on the stock you're trading, depends on the vehicle, how many ticks it might take, depends on the volatility of the instrument. But you could be in the S&P, you could be 10, 20, 30, 40 handles through a level on a daily bar chart, and it doesn't mean anything. Nothing's changed. That's really important. That's a concept of acceptance, which ties in with some other concepts that we use. So when you're picking time frames, it's important that you understand that if your two time frames, let's say your higher time frame context, I use multiple higher time frame context charts, but if you're going to use one, it can't be so far removed from your main decision-making time frame, because now all of a sudden above or below that level is actually insignificant the way you're trying to do it on a 1 minute chart. Extremely important. And there was a second part of the question, I believe. Market internals. Market internals is something that I think can be very value added to people. It's not something that I have. It's something that I've spent a considerable number of hours studying. I knew some guys at other trading firms that use some things. They taught me things. Some trading friends of mine taught me things about internals. I know enough to be dangerous with it. What I have found is that a lot of my tools, especially cumulative delta, tend to overlap a tremendous amount with what the internals are telling me. Short-term tick or cumulative tick is different. It can definitely help with like short-term extremes. So anyways, I think there's a lot of value in market internals. If I traded one market all the time and I didn't have such a dang good read on context with my NADRO toolkit, I would absolutely use market internals. But that's not going to be a repeatable process for me with soybeans and gold and crude oil and the 10-year note. So it's just not something I'm just good enough to get away with not using it in a lot of other ways, quite frankly. Rodrigo, hey Merritt, what instruments do you recommend for a newbie? I'm only trading MES, but I want to expand my basket of instruments. Here's the answer, is that there is no, I can't say this symbol, this symbol, there you go, enjoy your week. No. It depends on what you're doing, you know? It depends on what the style is that you're developing. It depends on the personalities of markets that you tend to like. So MES is, I think, or the S&P ES is a good middle of the road type market in terms of liquidity, in terms of pace of play. And you can dip your toes with something that might be slower, experiment with, and don't hate it after 10 minutes. Stick with it, spend a week with it, really get to know it, really watch it, okay? So don't give up too quickly. Something on the slower end is something like the 10-year note. ZN is what is typically used as symbology for that. Something faster might be something like the NASDAQ or crude oil, NQ or CL. And a lot of those markets outside of the 10-year, I believe, are going to have micros that you can, keep your risk smaller. So you got to find out. There's really no shortcuts to finding out what markets you like and whatnot. Don't be too short-sighted with your judgment of those markets would be my recommendation. Trader77, in Sarah chart, do you have the based on input only setting on or off in your VWAP charts? Do you know what the difference is? I found nothing about it in Google. I think mine is set to off. Yeah, it's set to no. Yeah, I'm not an expert on that particular setting. I think that if you're trying to apply it to like different sources, well then within any indicator or study within Sierra, there is on the left hand side what it's based on, right? And so whatever you select, whether that's the main price graph or some other data set, that's what that's referring to. So it only comes into play, I think, when there's complicated multiple things you might be basing it on. How do you identify price targets when building algos? First of all, I'm not an algo specialist, so let's start with that. But I tend to fit the target or targets to what the style is of what I'm trying to do with the algo. So, for example, if I was going to do a big narrative contextual algo, I would either make it based on actual references that the context is derived from on higher time frames, or I would set it to some type of read on volatility that's fitting to the time frame that those trades are typically held for. So maybe something like an ATR, right? Something like if I'm holding all day, holding for multiple days, you can use different things, right? The only algo that I'm messing with right now is a shorter term scalping algo. It only looks to take advantage of kind of short-term rhythm moves, and so I based it more around what kind of volatility, what kind of ebbs and flows, rhythm are we seeing. It's in the NASDAQ, so in the NASDAQ. So that's kind of what I look at. There's other ways. If you want to kind of curve fit it, you can do so. Just be careful when conditions change. Volatility picks up, volatility slows down or gets lower. Then all of a sudden your targets are out of whack for what's possible and what's at hand. Again, I'm not an expert on those things, but that's my take. Do natural traders calculate our acceptance picture on the trading time frame based on the medium term or short term rhythm? Well, there's more questions you need to ask there than just that. Natural traders also have the option of not even calculating acceptance on the trading time frame. The safer way to do it is to calculate acceptance based on the higher time frame rhythm and acceptance read on the time frame in which the reference is coming from. The more aggressive way of doing it, and there's a time and a place for this, and there's not enough time, and this is not the place to discuss it, but definitely head over to the community site. In fact, I think there's been some really good threads that have been on this exact topic. So do a little searching, poke around, people will point you in the right direction. But it's a great question. To answer the second part of the question you actually asked around short-term rhythm versus medium-term rhythm, I tend to do it on short-term rhythm. Medium-term rhythm has kind of some special use cases, I think, for handling some messier sequences and, doing some stuff like that. But day in, day out, I focus mostly on short-term rhythm, as we call it. Not being micro, but a good short-term rhythm. Hood Rich says, what is your right side of the V for your executive time frame? I think he means execution. For example, some traders may use an engulfing bar that they then risk under. Some may use wicks, etc. Great question. I use all of it and none of it, and all of it is the answer. I don't care if it's a wick. I don't care if it's an engulfing bar. I don't care if it's an inside bar that breaks out. I don't care. The point is that it's a momentum shift. And so I've learned of just how to see those. Quite frankly, my students will know things like dumb trendline breaks. Things like Heikinashi is a nice beginner tool to help you see where there could be significant momentum shifts. There's other things that go into before you get to the point where you say, hey, I got a great momentum shift. Well, not all momentum shifts are tradable opportunities, right? So you need to go, in our case, a top-down approach to get to the point of caring about a momentum shift, right? But there's a million ways to find momentum shifts. Stochastics, MACD, RSI, trend lines, Heikinashi. The list goes on. Almost all the moving average crossovers. I mean, whatever, right? Just I've gone through all those tools, over the past decade and a half, and ultimately for me, and for most people, I think you have this epiphany, if you will, of going from needing the tools, which are essentially training wheels, and then your charts end up getting cleaner and cleaner, and you can just kind of see those things in the price action itself. Price action patterns, there's all kinds of ways of seeing that, and one is not in particular better than any other. I think learning how to be a little more holistic, when to use short-term rhythm versus medium-term rhythm being appropriate, when to see when there's clean price action, speed of the tape changes how aggressive you can be with identifying momentum shifts. When things are slow, there's little herky-jerky things that aren't significant. The real question is, how do you see significant momentum shifts? And that's a skill that just is acquired over time. I certainly teach people what I know about doing that, and while at the same time trying to keep it simple. A really important topic that's closely related is the fact that I see short-term momentum shifts and where I execute and do things as random, right? On my good days, when I'm crushing it and timing things really well, it doesn't look random, but I can assure you that my mentality at the hard right edge whenever I'm doing those is that it is random, and that I have an idea of where price is trying to get to. I have an idea of where price should not go for that bias to remain intact, that idea to remain valid. And then I'm just operating in the randomness in the meantime, taking advantage of ebbs and flows as I can see them with the current characteristics of that market. But it's really important to know for any execution model, right? And this is high level stuff here, guys. I see my trading as one that has an overarching system that tells me, do you want to be long? Do you want to be short? What's it called? Should you be doing nothing? What is it called for? And this is how most of the best quants in the world operate as well. And then there's an execution algo, and that's totally different. They have nothing to do with each other. And that's how I trade. My execution has nothing to do with idea generation. And that is, probably the best gem you'll get from me all day on this call today, is starting to open your eyes to the fact that those things should be very different and based on very different things. And then you have a risk model which sits above all of it and controls everything underneath it. All right, I'm going to start skipping some traders because they're asking I'm going to get to people who haven't got a question answered yet. Nivan says that if we have expected edge, there's no reason to alter risk if it's already been calculated out to positive over time. That's probably a comment on what we were talking about earlier. Raphael says, hi, Merritt, can you explain how you pick between ETH and RTH? I get this question every week, I think. Do you have some if statements that help you choose one over the other? I spend my day watching both and end up having analysis paralysis. The best trades are where they both make sense. We can start with that. One might be from VWAP while one's from an extreme, or vice versa, or whatever. I tend to predominantly look at ETH. RTH is very much secondary. One if statement for you is if the overnight session is very large and wide ranging, and you have a very much ballooning ETH off the open early on. Once RTH settles in a little bit, it's going to be something I look at a lot more than usual, just because it's going to be giving me more meaningful, quicker information, whereas ETH, it could take all day for us to touch some extremes or do different things. John says, what are your thoughts about hedging instead of a stop loss? Say you're looking long 10 MES. Instead of taking your stop, you short 1 ES. Then you look to add when you get another signal lower. Yeah, I think this is, I had this exact same thought when I was coming up early on in my trading. It's very common, very natural to think around this. I think that if we were to talk about this over the next 4 hours, where we would arrive at is that the only thing that you're doing by doing that beneficial, well, not forget beneficial. The only thing that you're doing by doing that is increasing your costs. At the end of the day, once we talk about every single factor, that's the only thing that you're doing is increasing your costs there. There is no benefit to hedging because all you've done is bring in another round trip on another instrument. And now, yeah, maybe your risk is your P&L is not changing, just as it would not be changing if you just flattened out. And at a certain point, you either have to take all the hedges off or both positions off so that you maintain unchanging P&L. And by the way, there's transaction costs and commissions to doing so now with 2 instruments instead of 1. So there's your increased costs. Or you have to get to a position where you either take one of them off to get the directional exposure that you want, or you have to double one, as you suggest, to get more directional exposure. So this idea that you can just trade both sides and then just work out of each of them as they go favorably, it's flawed. It's a fallacy. It's not correct in terms of it there being benefit to doing that. But as I said a second ago, when I was a young trader, I thought that would be cool too. Graham says, reading Jones' book, Value-Based Power Trading, and mentions about fixed time period for an overlay. I was thinking of looking at value based on overlapping to merge those days to create true value. What are your thoughts? Yeah, evidently you haven't taken my course, but that's certainly what I teach people to do, and that's what I do. John, the idea that you would have a long-term bias and look to accumulate long positions as price falls while going short to cover the downside. Is that the hedging thing? Right. Again, yeah, do the math. You'll figure it out. Ken, hello, Merritt. Could you give us an example of how much room you give a stop on, for example, a double top? Is it always based on a level or something just point wise? And how do you decide on that? Thank you. I'll throw in an extra freebie for you there. A double top is a bullish pattern, not a bearish pattern. Unlike how it's taught in every single beginner trading book. So my stops are, well, we got to back up one more level here. I have different tactics that I will apply at different times for stops. Essentially 3 main categories that I use of stop loss tactics. If you sign up for one of my intensives, you can watch me do it live. You will see me occasionally use different tactics. I'll talk about that in real time, why I'm deploying those, why it makes sense, why I want to give a trade more room, why I'm giving a trade no room, why I'm doing something in between. But my stops are generally, the 3 categories are kind of like really tight, what I call kind of momentum type stop, where you're either right or you're right out, or a normal stop, which is kind of beyond an area, a turning point or wherever, where I've defined, kind of going back to a prior conversation, a shift in momentum. And if that's no longer true, that's not a turning point in the market that leads to favorable movement, then I'm out of the trade. Or a little more rarely, I will place a stop fairly wide, and I might even piece into a position in tiers, if you will, rather than be all in, kind of full size, full risk from the get-go. So not enough room today to talk about all that, but those are kind of different tactics I apply. So kind of to answer your question, I can't just tell you. It's certainly not fixed. Traders who trade with fixed stops are amateurs, period. I don't care how good they tell you they are. If you trade with a fixed stop, it's stupid. Volatility changes. You cannot, with a straight face, tell me that you will trade the S&P with a 6-tick stop, back in the summer of 2013, right? And you cannot tell me that you will trade the S&P with a 6-point stop in March of 2020. You're like doing stand-up comedy. It's funny. You have to be dynamic, guys, with your stops. They need to be based on market-generated information. Now, if you're running some kind of quantitative algorithm that spits out a number of where your stop should be, guess what? That's dynamic too. And you say, well, today I'm trading with this size stop or whatever fits your program, great. But just to say that for forever I trade with a 2-point stop or I trade with a 15-tick stop in crude or whatever, you're never going to reach your full trading potential until you're more dynamic with what you're doing. You can still be quantitative, but you have to be dynamic, and quants are good at being dynamic. How many prop traders does Apteros have? I think we have 6 or 7 at the moment, not counting me. Daniel says, which zones should I mark before a start pit session on the past TPO besides value area? Pretty much none. You can highlight, some significant poor highs or poor lows. You can split apart profiles if the value area is not a good one and create multiple value areas. But yeah, keep it simple. Look for balance. Identify balance. That's what the profile's there to do for you. All right, guys, we are out of time. I have to hop off. Thanks for being here. Thanks for the great questions. We will see you guys next time. Cheers.